Welcome to this morning's webinar where we'll be looking at the subject of exit planning. You'll see that my colleague, my friend and colleague Jack Spohr is on this slide, but whilst he is on the call, I'll be presenting today and Jack's role is to step in if I get injured or miss a penalty. So now just let's get going. There are many reasons why an owner manager might want or need to exit their business. And although we may touch on forced or distressed exits, this is not the main thrust of today's session. Instead, we're looking to encourage you to plan a little way into the future to ensure that you choose the most appropriate route out of your business. We'll explore the main strategies and how they work, and to help us in that, we're delighted to be joined by Simon Norton and Paul Tilson from Bristol Business Brokers and by Ian Nairn from Leonard Business Solutions. So here's a brief agenda. We're going to start off with this introduction here, moving on to an interview with Simon and Paul from Bristol Business Brokers. We'll be making the most of the opportunities in the middle section, and then on to handing over to Ian Nairn for his session from Leonard Curtis. And finally, we'll be getting all of our ducks in a row and summing up on the session. So here's our thought for the day by the playwright Tom Stoppard. Every exit is an entry somewhere else. So yeah. Now, before we go any further, it's worth noting two hugely important areas that we will not be exploring today because we simply don't have enough time and they deserve a session all of their own. So we'll be holding a second exit planning session on the 8th of September devoted to wealth planning and to the tax implications of exiting your business. Now, in some respects, we're putting the cart before the horse by holding today's session first because it's vital that you recognize that your personal circumstances and wealth cannot be divorced from those of your business, and therefore you need to know whether you can afford to exit your business at your chosen time in the most tax efficient manner. Therefore, you need to surround yourselves with all the appropriate advisors when drawing up your exit strategy. Our September webinar will call on our amazing colleagues at Robson Laidler Wealth and our brilliant tax advisory team. But what are your exit options? In simple terms, we've come up with 5 planned routes out of your business. Family succession, perhaps your son or daughter or both, or indeed another relative, may have an interest in taking the business on to the next stage of its evolution. And although this would appear to be the simplest and neatest of all exits, it's still something that should be thought through carefully in order to provide you with the funds that you need to live comfortably once you're no longer involved in the business. Management buyout. Although this can sometimes involve family members, it's likely to be the wider management team who buy the business from the existing shareholders. Both an MBO and family succession may involve an earn-out for the vendor, and there are many ways in which this could be structured. But the key is ensuring that the ongoing viability of the company to the satisfaction of all stakeholders involved in the transaction. With both family succession and MBO options, we at Robson Laidler are well placed to advise you on the optimum deal structure from all aspects. So third option is a company sale. So if you determine that no one within the business has the ability or passion to take ownership, you may decide to sell the business as a going concern to a third party. This is where our friends at Bristol Business Brokers will explain more about their process in the next section of the webinar. But in this scenario, the buyer will be acquiring the entire business, typically buying the shares in your company. An asset sale. In some circumstances, it may be decided that rather than sell the company itself, you actually sell the assets of the business. Stock, work in progress, plant, machinery, vehicles, and trade debtors, less trade creditors. This, in some respects, similar to a company sale, and it's likely that the trade name will be transferred, and that there will be an amount payable for the established goodwill in the company. And finally, if your business is heavily reliant on your skills and on your relationships, you may determine that none of the other 4 routes are available to you. But all is not lost, as you could opt for a controlled liquidation of your company and Ian then will talk you through that process shortly. So without further ado, I'd like to introduce our first guests, Simon Norton and Paul Tilson from Bristol Business Brokers. Bristol Business Brokers was started in 2018 to help SME business owners to sell and buy businesses. The business was started by Simon Norton in Bristol and now has brokers in Newcastle, Paul, and Bournemouth, with plans for a further 3 brokers to join this year. Bristol Business Brokers are well networked in each region and across all sectors. So over to Simon and Paul.
Yes, good morning all. So my name is Simon Norton from Bristol Business Brokers. We're just going to talk you through, I think we've got a number of, next slide's Bob actually, a number of questions that we'll go through, but here's the agenda. So we'll go through a discussion about the market in general, and Paul will talk around a bit about the selling of business and give you some insight into the process. And then we'll look at buyers and sellers and what you can, what both sides kind of, what's really important to both sides. And then we've got a couple of case studies to look at as well, because I think it brings it to life when you actually hear a business owner that's gone through this experience. And then we'll give you some tips on preparation for selling if that is your chosen route. Next slide. So over to you, Bob.
Yeah, so
questions.
Got a few questions to run through on this, if that's okay. So how has the how do you see the M&A market? How's that performed during the pandemic?
So obviously COVID, when it first hit last March, was it just stopped everything. All deals stopped for about 2 or 3 months, and I literally had deals working through that just kind of paused completely for about 3 or 4 months. But if I look at the stats across the UK, I think in May 2020 there were 58 deals. But to show you where we are now, in March 2021, there's been 153 deals closed across the UK. So the market has really picked up actually after COVID. I think there's a lot more confidence. And I think what I've noticed in particular is that the last 18 months has been a real moment for people to consider what their life looks like post-COVID. And I've certainly had lots of conversations with business owners who have perhaps been running businesses for 20 or 30 years, and they've just decided now is kind of a time to kind of look at other options, because they kind of, it's just, I think people have just inwardly reflected over the last number of months.
Great. So have you seen any particular trends or which sectors are performing well?
Yeah, so the sectors that are performing really well at the moment are IT and telecoms. They seem to be attracting quite a high multiple on the earn out. Also manufacturing has been particularly good. We've seen quite a lot of international investors looking to buy into the UK. In particular, we've got quite a few Chinese buyers at the moment looking to buy manufacturing. So manufacturing's particularly attractive. And also there's a trend for people who have left corporate. So we've had a few deals complete this year where people have come out of a good corporate career and they maybe have some money to invest. And rather than sort of going back into another career, they're looking to buy businesses. We've completed on a few this year where, they're completely. We had one chap who came out from Airbus, and he's bought a manufacturing business, and he's very happy now, and he's got a different lifestyle. So that's been a trend. We've also got lots of investors at the moment. There's a real trend. There's lots of investors that like to buy businesses that they can roll up into a group. So, they might buy 4 or 5 businesses and then sell again. And actually the multiples really increase. Once you get to a sort of a 5 to 10 million time business, you can then go to the private equity firms in sort of London and across the UK. And that will attract a much higher multiple on the net profit if you've kind of rolled them up as a group. And there's also another trend of people looking to buy, I dare say it, sort of boring businesses that are just good traditional businesses that haven't got any particularly exciting products, but they're kind of products that are well needed. And we've got a couple of buyers like that at the moment who are very good at marketing, in particular digital marketing. So they're on the acquisition hunt to buy, good solid businesses that they can then really kind of accelerate with kind of like modern marketing methods. I mean, we had one client that we did complete for, and his business, he's been going for 35 years, and he didn't even use computers. He had a blue lever arch file on the left and a grey one on the right, and that's how he ran his business. So, it was really attractive to a modern buyer because they could kind of implement some technology. They could put a really good marketing strategy, and they can turn that from a £500,000 business to sort of, multiple millions. So there's a real interest in those sort of businesses as well.
Brilliant. So, but have you seen an increase in any sort of distressed businesses coming to the market for a quick sale?
Well, fortunately, so far, no, because that would always be a very painful, conversation to have with a business owner. But I do think further down the line, I think, obviously we've got some, the next 6 months, I think will be quite telling. But, I think if people plan ahead, I think that they do have options. But so far, we haven't had any of those sort of conversations. So I think, that's a good thing.
Great. Shall we move on to the next slide?
Yes, please.
Yeah.
Okay, thanks, Bob and Simon. Morning, everyone. So when we engage with a client and we're looking to assist them to sell their business, there's kind of 6 or 7 areas that we really sort of try and focus on to, from our perspective, help them kind of get ready for that actual sale process. And the first one really is resilience, and that's more around the actual individual sort of selling the business. What we experience is, it's obviously a very emotional time. We talk to people about this sort of process all the time. But on the other side of the coin, it's something normally where, they may have done this once or twice before, or it might be their first time. So it's quite an emotional sort of mental sort of thing to try and get your head around. And so, we try and work with them to make sure that their resilience level is high. The selling process can be a bit of a roller coaster at times, and at times, can sort of, experience deal fatigue and stuff like that. So it's important for them to sort of understand this is a path that's quite normal, and not sort of feel like it's kind of going the wrong direction on a road, really. So we sort of work with them to make sure that they're kind of, motivated and ready for all of that. And then we sort of talk to them about, okay, in terms of sort of research, who do you actually think would buy your business? What's sort of going to be motivating people to look at your business? And very often people then kind of come to us and sort of say, well, actually, I've had a conversation with so-and-so, 2 years ago, who approached me. And that's sort of, very much a starting point of where you might sort of start doing your research to see who could be interested in my business. As Simon said, it's not necessarily, a direct competition. It could actually be an investor that's looking to sort of, roll that business into something else, or make it as a bolt-on, really, to complement the current portfolio that he has or she has. So it's really sort of, kind of getting your ducks in a row, and that kind of links with, the preparation piece as well. You really need to kind of compile a list of sort of, buyers information of who you think would look at buying it, and maybe the reasons why as well. Obviously, if you engage any form of kind of third party, they'll come to you with their ideas of where they think, they could sort of potentially help you. But it is important to make sure that you've got, as we say that to our customers, that you've got an idea of who you would ideally see, being really interested in this, and get that kind of company information and preparation all really sort of lined up. And then it's into kind of marketing, really. So this is an area of, where you present your business to the market, to advise them potentially that you're up for sale. Doesn't have to be sort of releasing any form of business name at that stage. From our perspective, any conversations we have when we go to market is all completed under a non-disclosure agreement. And so, it protects both parties for the obvious reasons. But there's various different routes that you can use for marketing. The obvious ones would be sort of, any form of advertising through, the websites that are around and about, should we say. But then you kind of get more into the detail of, going through things like LinkedIn, other different sort of more technical portals, probably sector specific and stuff like that. And actually even using things like Facebook You know, practically everyone's on social media for one reason or another, and so you know it's a very useful platform there. But it's an idea to get your sort of marketing strategy ready, really, so that you know which directions you're going to go, and then equally to understand where that interest has come back from, because you then know what works and what doesn't, so to speak. So in terms of selection, it's really important to make sure that you've got an idea of the criteria of the person or the company that's looking to buy you. You know, what type of buyer are you looking for? Are you looking for someone who's going to potentially invest, or looking for someone who's going to bring something else to the party? One of the things that we do really try and focus on when we talk to our clients is to make sure that they are financially sound when they come to you. So it's very important to kind of sort the wheat from the chaff, shall we say, in terms of, you know, what kind of buyer is going to sort of be able to, you know, go down this journey with you and understand sort of what that gold piece is really. And then sort of once we've kind of got to that point, it's very much starting to get into the meat, really, if that makes sense. It's, you know, about the negotiation. And I suppose one thing to sort of say here is it's not all necessarily about just the price. I think Bob sort of touched on it earlier about sort of structure of deals and things like that, because you may have a seller that actually isn't keen to exit the business, might want to stay on, you know, and as a PAYE person, or for you know some sort of consultant kind of thing, which would actually assist people like investors, because you know they'll look at the business very black and white. You know, what can they do with it? How can they roll it up? How can they, you know, go into it already knowing an exit plan? And so, you know, it's deal structure really, and understanding, you know, where your position in that sale will ultimately end at. Again, that could be deferred payment, that could be an earn-out period, it could be the fact that you do a share sale and on the basis that the exit plan is agreed in 3 years' time, that the whole thing's put up for market. So it's very much making sure that you actually sort of, you know, really get the structure that you're looking for, because there's nothing worse than being a disgruntled seller at the very end of the process. And then the final part, which is obviously the best bit, is deal closure and transaction. So, you know, here is very much sort of understanding, okay, so what actually happens on, you know, the last day of me owning my business and the first day of me not owning my business, really, or someone else owning my business. Because you then really need to sort of know, well, from a transition period, how am I going to be sort of affected? You know, how do I support the new owner? Assuming there is a transition period, 99.9% of the time we experience there is. So, you know, it's kind of the fun part, you know, when you maybe see a few extra zeros in your bank account, but it's also sort of knowing really, you know, where you go after that. So those are the sort of 7 points that we look at, you know, the process for selling a business.
Okay, thanks.
Thanks, Bob.
Okay, next slide. Thank you. So this is to give you an insight really into both sides of the transaction. So I'll give you an overview of kind of what the buyers are looking for if they're to buy a business, and obviously a bit about the sellers and kind of what's you know, important to them. So whenever anyone buys a business, the two real main key points that they've got going through their mind is, if I buy this business, how quickly will I get my return on investment? So if I buy a business for £1 million, you know, how many years will it take for me to get that £1 million back? So that's the key thing. And then the second really important point is about the risk. So it's all about, you know, what's the risk in terms of, you know, buying this business? Are there any sort of debts, or are there any kind of legal, you know, sort of lawsuits against the business? So it's really kind of making sure that those are being covered. But buyers, one of the things that really attract buyers, and I touched on earlier why the IT and telecoms in particular are doing very well at the moment. Buyers love recurring revenue. So if you've got a business that has you know, clients that are locked in on contracts, I mean telecoms in particular, they have clients normally on 3 to 5 year contracts where they've got monthly or quarterly payments with good EBITDA profit, then that's really attractive. Another thing that buyers really like is if the business can actually run without the owner. Quite often we speak to business owners, and their biggest problem to selling the business is the fact that they are really the business. They may have a team around them, but they're still kind of in a way a bottleneck. All the decisions are made by the business owner. All the sales and all the kind of key client relationships are with the owner. So if you can sort of build a management team around you, so then and sort of slowly exit yourself. So when you are ready to sell, if the business can literally operate without you, then again, that's really appealing, because it just makes it easier for a buyer to come in and to take over and either put into their processes or to grow. Obviously, it goes without saying that profitability is important. That's what they look at. Each sector is different, but normally the valuation of a business will, I mean, there's many different ways of valuing a business, but at some point it will be a multiple of a profit number. Now that profit number could change, could be net profit, sometimes it'll be gross profit. If it's an accountancy practice, it's fees, or legal practice. So, but there will be a multiple, but it will generally be the more profitable, the better multiple you'll get. Another thing that you look at as well is making sure that a business has got some really good systems and processes in place. So, everything, again, this goes back to my earlier point about the business can just operate without the owner. So some really good, advice is if you're thinking about exiting, maybe look at some of your systems and processes and maybe look at, could they run if I wasn't here? And actually kind of make sure that you do maybe a review and an audit on those. Touched on this already, but clients with contracts, I'll be amazed how many customers I speak to who say they've got lots of customers, but they're not actually on contracts. And if you go back to my earlier point about risk, so if I was to buy a business where there's say 100 customers on but don't have contracts, how many of these potentially could walk on day one of the transition? So again, if you've got a plan to sell your business over the next few years, it might be worth looking at all your contracts just to see and make sure you've got really good, sort of long-term contracts in place if you can. That's not always applicable. And the other thing is, unfortunately, there are quite a few sort of time wasters out there who say they want to buy a business, but actually when it comes down to it, they don't have the funds. So one of the things that are really important if you're selling your business, if you do it yourself or through any third party, is just make sure you're clear. It's a bit like if you buy a house, the estate agent won't let you put an offer in unless they've seen actual evidence that you can fund that transaction. And that's how we work as well. It's very much, people need to demonstrate, that they can actually buy a business. Now, most businesses are bought by leveraging either money from their own business, that's the buyer, or the seller. So there's a number of different ways that you can raise money, but very rarely actually do people use their own money. It's generally financed through various different vehicles. And sellers, so if you're looking at selling a business, this is kind of what's really important we find from actually sellers, is that they need to make sure they're speaking to motivated buyers, because again, like I said, touched on that, there's a lot of people out there who say they're ready to buy, but they're just not clearly ready. Finance in place. Make sure that they've got a defined exit strategy. So maybe it can take 3 years to plan a good exit strategy, and to actually sell a business, we find it can take up to a year to sell a business. We've got examples a lot quicker than that, but so if you're thinking about selling a business, maybe factor in it could take a year to actually find a buyer and to legally transact the business. You might also want to consider protecting some of your key staff. If they've been with you for a number of years, you get to know your staff very well, and you kind of want to look after those. So even if you've stepped away from the business, there may be a way that you can help them with the new buyer. So maybe make sure you've got some good employment contracts in place, or make sure there's some incentive for them to move to a new owner. Another really important thing, obviously, is about brand legacy. So that's obviously, I find that's one of the key things, that because people are proud of the business they've built up over a number of years, they want to protect that. So again, that's kind of really important, those part of conversations. And then the payment plan. So Paul's touched on this. There's so many different ways to structure a deal, but very rarely post-COVID are businesses bought 100% of the full price on day one. There's normally a payment upfront on day one, which can vary from 50 to 60% maybe of the asking price. and then a deferred payment, which again can be structured in a number of ways. But there isn't the appetite to pay 100% of day one, certainly from my experience over the last 18 months or so. And then the final thing really is to make sure that you work with your accountant, your tax advisors, your IFA wealth advisors, because obviously, you will be faced with potentially a large sum of money if you sell your business, and you just want to make sure you speak to the right advisors in your team that can help you sort of get that as tax efficient as possible. Thank you, Bob.
Okay. I think we're in danger of overrunning a little bit, guys. So could you pick one of these case studies?
Yeah.
Do you want me to pick final value? So, okay, I'll sort of speed talk as clearly as I can on this one. So to put this into reality, we engaged with the owner of Final Value. They make mobility canopies and canvases to go over the scooters and stuff like that. And that business was 37 years of trading from when his father started it. But for due to personal reasons, he just wanted to sell it. There was a number of things there. So we engaged with him and went to market to find him a buyer. And Simon sort of touched on it briefly earlier, where we found a gentleman who was coming out of sort of wanted to deshackle his corporate kind of life and make a future for him and his family, where he can potentially take a business and really kind of drive it into the 21st century, this was exactly it. The owner was running 2 folders, nothing was painted and stuff like that. And so, we literally looked at this and thought, okay, who can we kind of find? And the gentleman that we found was absolutely spot on for this. And the transaction took, we did it all online with the exception of one visit. But it took about 6 months, really, in the end. After that, and now that gentleman is building up his portfolio throughout the UK and really pooling on his knowledge of how to run a business. So yeah, that's a snapshot view of what we did for that company.
Thanks, Paul, and sorry to
no, it's all right, don't worry.
So we're actually going to skip over this because, as we said before, we're going to do Q&A at the end of the whole session. Next, so thanks, guys, for that. So next, it's great to welcome Ian Nairn of Leonard Curtis Business Solutions Group. And in this summer of sport, it would be remiss of me if I did not mention that only last month, Ian was made an MBE in the Queen's Birthday Honours List, having recently retired as the captain who led England to victory in the Physical Disabilities Cricket T20 World Series. So many congratulations, Ian, for both the recent award and the sporting achievement. Sadly, we're not here to learn more about that, but nevertheless, Ian does have some really useful information for you. So over to you, Ian, and I'll stop sharing and allow you to take over.
Super, thanks, Bob, and morning, everyone. Just give me one moment to get this all working for you. If you thought last night was exciting, just hold your horses. It's about to get lively. So I'm Ian Nairn. I'm from Leonard Curtis. Thanks, Bob, for having us along and getting us involved in this. It's nice to work with some accountants who are actually telling their clients to plan and look at the future as opposed to looking 21 months in the history. So Leonard Curtis are a professional services firm. We work alongside accountants across the country, just working to try and get positive solutions for their clients, basically, normally specialising around a time of change. So when things don't go quite as well, or when things are going well and are allowing people to retire. We're all around the country, as you can see, and the little dot in the northeast is me, and we're new to the northeast. We've been up here for about 6 months now. So on to the real subject. Why do you need an exit strategy? And some of this has been mentioned by the other speakers, but basically it is good practice to have a business strategy. Planning in general makes your business stronger. It allows you to make the right decisions about your business. It gives you a roadmap to follow and lets you know where you are on the route to your destination. It also, and perhaps shows up most importantly over the last 18 months, allows you to react to issues that come up within your business. So it's important to have all of the plans in place. And Simon mentioned certainly when coming to exit, you need to be planning ahead. the chances are you're probably going to be working with some other professionals as well. So whilst we aren't talking about them, those wealth planners and who are going to be helping you with retirement planning or estate planning might be involved, and they're going to need a plan in place to work with you and make sure that everything is done to the best in your best interest. Because ultimately, if you're anything like me, you're spending a lot of hours in your business, maybe more hours in your business than you are with your family. So you've worked hard to create what you've built there. You need to get as much out of that as possible, so that the future for you and your family is protected. I mentioned earlier about understanding the impact of threats. Hopefully, this year will be the end of COVID. Maybe we'll have to run into next year, but there will be other things that come along and affect your business. There'll be changing tax regimes. There will be economic circumstances that come up and cause you a surprise. But if you've got the plan in place, you can't change the external factors that are going to affect your business, but with the plan, you can respond to them more quickly and get yourself turned around on the other side. I think it's also really important to engage with specialists to assess the value that's in your business before, or as part of this. You might have a view that your business is worth a couple of £1 million in your own head, but in conversation with Simon and Paul, they might need to give you a more realistic appraisal of the value. Or they might say, actually, guys, this is worth 10 million because you don't know who we know. So you need to have that. If you engage with the specialist, they can assess the value and make sure that you are getting as much out of it as possible. And ultimately, it comes back to the 5 Ps, which fortunately Gareth Southgate and the team avoided yesterday. That planning does prevent poor performance. I think that was only 4 for the audience. So Bob touched on this earlier, so I'll not spend an awful lot of time on it. They are what they say. So you can sell the shares, sell the assets and trade of the business, or sell a part of the business. The next 3 are people who you might sell to, so the management team, competitors and suppliers. And I would say, if you're looking to maximise your business value, don't be precious about who you're selling it to. Ultimately, it's not going to be your baby once it's sold. And if someone who you might not be a big fan of is prepared to give you a higher multiple, that might be better for you and your family to take that and run to the hills. And the final one there is just a wind down. Sometimes businesses might not be saleable or might not be in a position that they can move on to someone else. So actually just understanding how you wind down a business, what that looks like. It often is the worst case scenario, but it can still be a viable route and it can still be done solvently. If you've planned your future, if you haven't planned your future, then there could be some surprises that come up and bite. So when to do it? And if we say that today is the 8th of July, there is still no definitive answer to that. You need at least a couple of years, would be our view on it. You might not come and talk to us about it at that stage, but you certainly want to be talking to Bob and the team at Robson Laidler about getting that plan into place, knowing what the exit strategy might look like at the end. So this is a long-term thing that you're doing to be able to maximise your value. And some of the considerations Simon and Paul touched on earlier as well. So it's the personal timing of your decision is going to be key. The majority of people that we deal with are owner managers, and it's something that has happened within their life. So it might be retirement, it might be a change of direction, the opportunity to go and do something different, or just an out of the blue approach that gets you thinking about a sale of your business. Economic conditions will have a big part to play. We assume that we're going to see some challenging conditions over the next couple of years, and if you can ride that out, there could be then a crest of a wave to ride on. But as the guys were saying earlier as well, M&A activity at the minute has been skyrocketing. The corporate finance world has kept itself going after the initial lockdown started, and solicitors in the CF world and the guys at Bristol Business Brokers are busy selling businesses, and people have cash to buy, so it might not be a bad time to look at it. I think it's also worth just considering the risks of personal liabilities. I think the way that the funding market is operating at the minute, the chances are that if you're looking to borrow from any level of funder, be it high street bank or tertiary lenders, they're going to be looking for some form of personal guarantee. We're in a rocky economic climate at the minute, and what you don't want to do is get yourself into a position where you've got a pile of debt that prevents you from selling the business, or that eats up all of the cash from the business, unless your ultimate goal is to just walk away with nothing. So being aware of what your exit plan is before you go and borrow money now is certainly a good idea if you think your business is going to need some funding to move forward. Simon mentioned about asset sales strategies, and the how, whens and whats, and speaking to agents is really important, because values can change. We dealt with a printing business a couple of years ago, and the hard print business in the UK is pretty much non-existent, but the print business in India is absolutely flying, and the values that we got for the kit by selling them to India as opposed to trying to sell them in the UK, really improved the outcome for the business. So I think it's just understanding we are in a global market at the minute, and there might be buyers further afield than you would imagine who will pay good value for things. Seasonality is also going to be really important. If any of you have got seasonal business, if Santa Claus was selling Christmas, would he sell before Christmas, just before he makes his profit, or would he wait until the new year when he knows that he's got all of his cash in? And that's something that you want to consider. Ultimately, it might affect the price that you get for the business, because if you've had your good bit and they know that there's going to be a big cash tie-up in the business, they might seek to just pull a bit off you. But it's all worth weighing up and speaking to the specialists about that. And ultimately, there will be some tax regime changes, as I said. Watch out for the budgets and the financial statements that come from Mr. Sunak currently. There are constant talks about changing regimes. And if we're going to pay for this, for all of the furlough work and the likes, we are going to have to do something about that. So why are you listening to an insolvency practitioner talking about selling businesses and running off to retirement? That sign and the advert that's on the page might be your expectation, but we do help clients to get positive outcomes from various starting points. And the main reason that I'm here today is to talk about business asset disposal relief, the snappily titled. It used to be called entrepreneurs relief, which was much more snappy, and people understood what that meant. But basically, a liquidation is an opportunity to take a capital repayment from a company, and that allows you to reduce your rate of capital gains tax down to 10%. Now, that must have piqued your interest a bit, because everybody likes the opportunity not to pay some tax. So how are we going to do that? So a members voluntary liquidation, Bob touched on right at the very start. And ultimately, I would say, don't let the word liquidation scare you. If you come and have a meeting with me, I promise I won't give you insolvency. If anything, I might help you avoid insolvency, but we're not contagious, so you should be fine. A members voluntary liquidation is solvent, and that's the key bit. Your assets are greater than your liabilities, and you can repay them within 12 months is the rules around swearing a declaration of solvency, which is what you would do as directors and shareholders. It can run on for more than 12 months. So if there are some issues with realizing assets to repay all of the debts, we can, we don't have to stick to that 12-month limit, but it's you're saying that you have the ability to do that. You definitely aren't on the naughty step in doing this, doing a process along an MVL route. We can deal with assets that are both liquid, so your cash assets, and illiquid assets, which we can look at distributing in specie, and I'll come on to that in an example later on. But it gives us a lot of flexibility to be able to deal with assets in a way that works best for the shareholders of the business ultimately, and that's the key bit. And also, we do get clearance from the revenue before we do this as part of the process. And I think that's really important for you to understand that this is something that the revenue approve once we're into it, and then that can't be questioned as you move forward. So I've put a bit in about the rules around the BADR. For anyone to benefit from the reduced rate of CGT, they must be an employee of the company who's owned at least 5% of the business for at least 2 years. and the company can't have ceased to trade for more than 3 years. So you do have a timeline from ending your trade period of trade to actually commencing this process and benefiting from the reduced rates of tax. There are rules around partial sales, so you can actually just sell off a part of your business. As long as that part is viable, then you should be able to claim entrepreneurs relief. But ultimately, this is where we pass the buck and say you need to speak to Robson Laidler and their excellent tax team to get advice around this, because we aren't tax people. We're insolvency practitioners, and we would always defer to the tax man about their specialist skills. We have our own specialist skills, and we'll leave that bit to them. So a little example, and hopefully this isn't too far away from something that Simon and Paul might have seen earlier. As part of your business, you've got a business premises worth £250,000. That could be sold to a buyer. It might move into a pension scheme of one of the directors or shareholders. It might be moved across into a new property holding company that becomes an investment vehicle for the shareholders. And all of that is worth taking advice with your advisors around what's the best route to deal with that property. Plant and machinery, a couple of £100,000, that's likely to be sold to any buyer. And a goodwill, as was mentioned earlier, you're likely to get that cash up front, potentially with a bit of deferred consideration in there, but that would depend on the terms that you negotiate. There's an overdrawn director's loan account in there, so where maybe the company didn't quite have enough profits for you to draw dividends to cover off your drawings. Nothing to worry about in this scenario, but certainly something to watch out for as you move forward in life. Overdrawn director's loan account issues are problems that we deal with an awful lot of the time, and cause nothing but headaches. So if you have an overdrawn director's loan account, talk to Robson Laidler about how you might be able to reduce that. That would be a good thing to do. You're going to have some debtors. You're not going to have collected all of your cash in by the time you sell the business, so there could be some debtors that are coming into you, or they might have been sold as part of the sale deal, and a bit of cash left in the bank. So a nice little transaction there. I wouldn't mind if I could get to that part of my business. So all of the liquid assets, so the cash, there's about £345,000 there. Once you've sold the plant and machinery and turned that to cash, that would be distributed as cash to the shareholders, and it's issued based on the shareholding. So if you've a husband and wife team with 50-50 shares, 50% goes to Mr., 50% goes to Mrs. Nice and straightforward. And that's normally done within 2 to 3 weeks of the company going into liquidation, subject to how long the cash takes to come from the bank. The in specie bit is where it can get a little bit more interesting. So this is where we're saying the assets haven't been sold and we're going to pass them across to somebody else. So we can transfer the business premises, as I said, so that you might decide to put that into your pension scheme to bolster that over the course of the next few years whilst you enjoy some time on the beach. The debtors, what we can actually do with that is assign the payments and assign the debts over to the shareholders, so that the benefit of the cash as it's paid by your customers comes to you rather than being left in the company. And where there's a director's loan account, that would normally get repaid to the company. It doesn't have to be repaid. You can distribute that in specie, but there are some issues with the revenue that the guys at Robson Laidler would advise you on, where they can treat the director's loan account as income, therefore being treated as pay-as-you-earn earnings, as opposed to being a capital repayment. So you do just need to be careful with that, and we tend to just play a bit of money roulette and send money back and forth until we've repaid the loan account. So there was £700,000 from our example to be distributed to shareholders. We're simple people, insolvency practitioners, so I've said there are 2 shareholders. That makes it nice and easy. And based on the 10% tax rate, which is also nice and easy for us, that means you're looking at a £35,000 tax liability per shareholder. Now, that doesn't account for your personal allowances of £12,500 a year, and that's per shareholder. So that situation's going to improve as well. And your tax liability will fall due on the 31st of January, the following 31st of January. Now, one of the things that we can look at with your tax advisors is whether we can split that the distribution over 2 tax years. So we quite often see a glut of MVLs coming to us in March to try and get the distribution in before April, so that you can take advantage of both capital allowances. You do need to be a bit careful with that, because the revenue can actually say, no, sorry, this was just one distribution. You've done it for tax benefit and not because it was there. But particularly when we've got some assets to distribute in specie, then there is a sense in splitting the distribution up for your benefit as well. I think ultimately we are at a £1 million lifetime cap on entrepreneurs relief at the minute. That dropped from 10 million, and I think this is one of the areas to flag that there was talk. Rishi Sunak was on BBC News just this morning, being questioned about where would you go, and capital gains tax is definitely something that they're looking at. It would seem, I don't think it's sensible or likely that they will scrap it, but I do think there could be some changes to the rates or to the caps. So it's all worth keeping an eye on that and speaking to your tax advisors on that one. So you might think that that's a bit of a pain in the backside. Are there not any other options that are available? And there are other options available, but I'd probably just draw your eyes to the middle of that screen and look at the rates of tax that you're going to be paying if you take your assets out in other ways. You can spread it out over a number of years and take dividends, but you are going to be paying the good people at Robson Laidler a little bit of money to produce your accounts and submit your tax returns for you, and that might outweigh the costs of the MVL process. And as well, subject to your other earnings, might actually increase your tax rates. So it is worth just bearing in mind that obviously if you do it as a single distribution outside of an MVL, then you're talking about CGT at 20%. And if you're a higher rate, then up to 32.5%. One of the big challenges that we see, or not challenges, that is the wrong word. One of the questions that we see is, I haven't got much assets. We're talking about 25 grand left in the bank. The company ceased to trade. What can I do? And ultimately, if you've got less than 25,000 in the bank, that's automatically treated as capital gains tax and taxed accordingly. Sorry, capital gain and therefore taxed accordingly. You do need to be aware that you can then just dissolve the company, but you need to just make sure that you have realised all of the assets in the company. That's a really nasty mistake for people to make when there are assets left behind. Adhere to the rules. Obviously, we deal with MVLs every day of the week and twice on a Sunday. You're not going through an MVL process, but there are rules and steps to follow. And whilst your accountants will be able to help, it's always worth making sure that you've done that. Your actions can be questioned, and that can produce some personal liability for you if you get anything wrong, and the company could be restored to the register for the next 6 years. If you just got a little bit more assets, so if you're up to about £75,000, then it's definitely worth considering your personal earnings and your personal tax rates. Review them with the Robson Laidler tax team. MVL can give a better outcome at that kind of level, particularly for higher income earners. At the lower level, it might be touch and go, and you might consider that actually just take it and run. So we're approaching the end. After the last 18 months, this looks like heaven. I can't wait to get towards the beach. You've spent a long time building your business, much more than those 18 months, so it's your chance to enjoy that retirement, especially if we can travel abroad. But what we don't want to see you do is get stuck around the kids' pool rather than that glorious Caribbean beach. And I think there are just some things to consider around that. So your plans might not always play off. Plans are estimates, and they allow you to follow a route, but sometimes things might go awry. A sale might be unachievable. We could have an economic downturn. Technological advancement might just mean that your business no longer has a future. We dealt with a gearbox manufacturer just a couple of months ago, and because of the impact of electric vehicles. There aren't gearboxes in cars or in those cars. Their business has probably got a lifespan of maybe 5 to 10 years. And so they had their last chance of exit. So you just need to be aware of where things are going within your sector. You might see a new big competitor arrive in the Northeast, lose a major client. And I think one of the other things is potential greed. The value of something is what somebody else is prepared to pay for it, not necessarily what you think it's worth. And that's always worth remembering around the sales process. So if your plans don't pay off, then there are some other things that are just to be aware of. You will need to pay redundancy costs if you want to walk away from your business and you have employees. So it might be worth in the latter years considering bonuses as opposed to pay rises. Bonuses don't affect the redundancy payments, whereas pay rises do. Redundancy is available for directors as well. So again, as a tax efficient way to take some money out of the business, that might be a route, because redundancy is a tax-free payment. Because you've had a plan in place for a couple of years leading up to this point, you will know whether the company is going to be solvent, or at least I would hope so, at the time that you cease to trade. There's a whole other presentation on what happens if we don't get there, and if anyone needs advice, my contact details are there later. But it's best to avoid that wherever you can. We mentioned personal guarantees earlier. You don't want to be selling your business and then losing all of that money to settle those debts. And just be careful with antecedent transactions and the overdrawn directors' loan accounts that we mentioned earlier. Those payments that you've made to friends and families and connected parties where you should have made payments to your creditors. And if you haven't made payments to those creditors equally, so if you haven't treated all creditors equally, then again that can just bring about a personal liability fee. So it is an exciting time moving to what you're looking at, the plan of retirement or the plan of exit and moving on to the next thing. It's definitely worth taking advice around everything that needs to be done. Speak to lawyers, speak to solicitors, speak to business sales agents. And if you need us, come and speak to us. We are here to help. And if there are any questions, hopefully,
I think we'll keep the questions to the end of the session, if that's okay, Ian.
And I will just stop sharing and hand back to you.
So thanks for that. That's excellent. And I shall try to share. Yeah. So thanks, Ian. And thanks to Simon and Paul as well for your excellent input. So next, we're going to cover some things that to look at when considering an exit. And there are two main reasons, probably more, but two main reasons for wanting to exit your business. You may want to do other things. Perhaps you've developed a strong interest in other business activities and want to switch careers, or perhaps you want to retire. In either case, when would you ideally like to exit your business? And can you afford to retire at your chosen time? And is your business in a really fit state to optimize the outcome for you and your successors? So picking up on that previous slide, it's vital to involve your wealth advisor and tax specialist to ensure that that you can afford to retire or fund a new venture. And we would therefore encourage a round table approach involving a variety of experts, including ourselves as your accountants and business advisors. Once you've verified what you need and when you need it, the next step would be to work with us on identifying the most appropriate exit route from those that we've looked at today. And then we would ideally be looking at a planned exit at a defined point in the future where we can explore where your business is now, where you want to be in terms of value, and at the time of your planned exit, and we can work with you to ensure that you achieve that value. And we do that leveraging our now, where, how techniques combined with our privileged access to your business financials. So in summary, our guests today can help you to achieve effective and optimum results with the mechanics of disposal and winding down of a business, whilst we, along with our wealth department and tax advisors, can help you to plan for a controlled exit and maximize the value of your business at exit.